1.5 Asset Misappropriation, Inventory, and Other Assets. Hello everyone, I'm Yazan Ibrahim, or as some of you might know me, Yazan Abu Ghosh. Today we're going to dive into a fascinating and essential topic. Fraud Examiners, Section 1. Financial Transactions and Fraud Schemes. 1.5 Asset Misappropriation, Inventory, and Other Assets. Welcome to today's deep dive into the world of accounting, where we'll explore the misuse of inventory and other assets and theft of inventory and other assets and misappropriation of intangible assets. Whether you're an aspiring fraud investigator, a business owner, or simply curious about how organizations manage their finances, or if you are auditor, this journey will shed light on the often complex systems that drive decision-making. Imagine walking into a bustling company warehouse, shelves stacked high with inventory, employees moving briskly, seemingly immersed in their daily duties. Yet beneath this veil of activity, a subtle, almost invisible web of fraud might be unfolding. This educational journey takes us deep into the world of asset misappropriation, where stolen pens and pilfered computers meet grand-scale schemes costing companies millions. This isn't just a story about theft, it's about trust, responsibility, and the unseen costs of misconduct, a world we are about to uncover. Misappropriation of inventory more than meets the eye. When discussing asset misappropriation, most people immediately think of cash. But what about the countless items businesses rely upon? The non-cash assets like inventory, tools, vehicles, and equipment. These assets are prime targets for misuse and theft, often in ways that fly beneath the radar. Picture this: an employee borrows a company car under the premise of urgent work matters. Instead, they head off to run personal errands or perhaps even take a mini road trip. No permission granted, no accountability given. In one instance, an employee falsified both written and verbal reports about their car usage, claiming it was strictly business related, when in truth, it was far from it. Although the vehicle was returned without damage and the tangible financial loss was slight, the act itself, rooted in deception, qualifies as fraud. But misuse isn't always limited to vehicles. It can manifest innocuously. A worker using office computers to run their own side business. Sometimes this side hustle directly competes with their employer's operations. A betrayal that cuts far deeper than the misuse of company supplies. The line between borrowing and outright theft often blurs in these scenarios, creating challenges for businesses when tallying the true cost. Though a borrowed stapler may seem trivial, employees misappropriating equipment for personal ventures could translate into diminished productivity, unexpected repair costs due to wear and tear, and in some cases significant financial hits when stolen assets are never returned. Theft, a deeper, more costly concern. Now let's lift the veil on the more egregious side of misappropriation: theft. Unlike misuse, theft typically involves deliberate and calculated efforts to remove assets permanently, often carried out through one of four key schemes: larceny, asset requisitions and transfers, purchasing and receiving scams, or false shipment frauds. Larceny, the simplest yet most blunt form of theft. Imagine a warehouse clerk casually walking out with company tools in plain sight. It's brazen but surprisingly effective. Co-workers, bound by trust or fear, rarely question the act, assuming there's a legitimate reason behind it. This is larceny, theft in its rawest form, where the perpetrator makes no efforts to conceal the crime through financial records. Take the cautionary tale of a university faculty member. Granted limited permissions to take work-related materials to a new position, she exploited the system, loading 2 trucks with lab equipment and computers worth hundreds of thousands of dollars. What made it possible? Trust, the very foundation of workplace relationships. When co-workers are aware of misconduct but choose to remain silent, whether out of fear, loyalty, or lack of proper reporting channels, these schemes flourish unchecked. And when high-ranking personnel are involved, even fewer dare to act against the perpetrators. For instance, a school superintendent abused their position to stockpile school assets in their home cellar. Years of unchecked theft went unnoticed because employees feared retaliation. Sophisticated tactics and accomplices. Not all thefts are so straightforward. Think of an employee, crafty and strategic, who avoids the embarrassment of being caught red-handed. Instead of physically walking off with stolen goods, they mail valuable inventory, like computer chips, to a private address under false pretenses, using the postal service as their unwitting accomplice.
In another scenario, a person conspires with an outsider using a false sale. To onlookers, it appears to be a legitimate transaction. Merchandise is bagged, a cash register dings, and maybe a small exchange of money completes the illusion. But behind this facade, the items leave the store unpaid. Fueled by accomplices and deceit, such schemes highlight just how inventive fraudsters can be.
Fraud in disguise, asset requisition and transfer scams. Have you ever wondered how internal paperwork meant for day-to-day operations can become a tool for theft? Enter asset requisition fraud. Here, employees manipulate documentation to gain access to restricted assets. In one case, a telecommunications employee fabricated project documents to requisition $100,000 worth of computer chips. Knowing stringent approval processes involve verbal verification, the perpetrator rerouted calls to themselves, granting their own fraudulent request. Ingeniously crafted but ultimately uncovered. Sometimes these schemes hinge on overstating material requirements for legitimate projects, pilfering the surplus for personal gain. Other times they involve entirely fictitious projects with bogus asset requisitions paving the way for theft. Purchasing and receiving scams, a tactical approach. Finally, consider how dishonest employees exploit procurement. By falsifying records of received goods, perpetrators can skim assets off the top. Suppose a shipment contains 1,000 units, but only 900 are recorded. The missing 100 units conveniently disappear into the hands of fraudsters. However, coordinated efforts often minimize the discrepancies that alert management. Employees might alter one set of receiving reports for inventory records while submitting another for payment records. Others may reject portions of shipments as substandard, only to keep the rejected items for themselves. Connecting the dots, awareness and prevention. These tales of deceit are not just stories of wrongdoing, but reminders of vulnerabilities in our workplaces. Misappropriation, whether it's minor borrowing or elaborate theft, undermines trust, jeopardizes financial health, and creates ripples far beyond the immediate loss. From implementing checks and balances to fostering open communication, businesses must strike a balance between trust and oversight. As we conclude, let these stories serve as both a cautionary tale and a call for vigilance. Asset misappropriation thrives in silence and ambiguity. By shining a light on these schemes, we take a critical step towards prevention, safeguarding not just businesses, but the communities and individuals who depend on them. Picture yourself stepping into a bustling stockroom, rows and rows of stacked boxes meticulously labeled on every side. At first glance, the inventory seems abundant, but beneath this deceiving facade could lurk fabricated schemes. Some boxes might be empty, others filled with bricks, carefully placed to trick the eye and inflate the illusion of value. Fraud in inventory management often hides in plain sight, and its detection requires an arsenal of sharp tools and strategies. Let's start by delving into the craft of uncovering fraud. One crucial method is statistical sampling. Imagine trying to find a single defective bead in a jar of thousands. Instead of inspecting each bead, you take random handfuls from various levels, sniffing out patterns and inconsistencies in the smaller sample. This is the power of statistical sampling in fraud detection, a way to inspect critical bits of data and extrapolate findings to the entirety of a system. Consider analyzing purchase requisitions. Are they all approved properly, or do you notice some seem to bypass established protocols? Similar techniques work on items like receiving reports, perpetual inventory records, raw material requisitions, and even shipping documents. Now, let's talk about perpetual inventory records, the real-time heartbeat of stock tracking. Here's where unexplained entries might sound the alarm. For instance, are unexplained reductions in stock traceable to proper documentation, such as sales invoices or approvals to scrap inventory? If not, you might be looking at an embezzlement scheme. What about the shipping process? Fraud can lurk here too. Every sale should have a paired shipping document, and missing matches could expose inventory disappearance. Questions like, is inventory vanishing without explanation from storage, should never go unanswered. When probing physical inventory counts, keep in mind that numbers in the ledger sometimes tell half-truths. Shrinkage might initially seem innocent, just routine wear and tear in the normal course of business. But in reality, these shortages could be masking deeper issues. A year-end count alone won't do. Thorough analysis over time is critical. Through the lens of analytical review, Peeling back trends can reveal more than just numbers. They hint at unfolding stories. For instance, in a healthy system, sales and cost of goods sold, COGS, move in harmony like a well-rehearsed duet. But what if COGS suddenly climbs disproportionately without external triggers? No major changes in pricing, quality, or quantity purchased. This crack in the foundation could point at multiple culprits: theft, depleting ending inventory, false billing schemes, or revenue skimming. Take a hypothetical scenario. Year 1 and year 2, side by side, show some eyebrow-raising differences. Sales rose by 9.12%, but COGS surged by a shocking 17.26%, shrinking profit margins from 55% to 52%. Diving into the inventory matrix uncovers disappearing ending inventory. It plunged 29.64%. What are the possible explanations? Could excessive purchases in year 1 have been strategically liquidated in year 2? Or did unexpected growth outpace inventory purchases, leaving gaps? Without sufficient reasoning, fraud might lurk in the shadows, demanding deeper inspection. Here's a compelling example. Suppose purchases were consistent across years, and starting inventory didn't change drastically. What could explain stock mismatches except manipulated numbers or poorly tracked physical inventory adjustments? Investigating these components, beginning inventory, purchases, goods available for sale, and ending inventory, is key to unraveling fraud.
To take things a step further, modern computers and trend analyses become formidable allies. Imagine being able to generate tailored reports at will. For example, a lumberyard operation might isolate all purchases for 4x4 cedar fence posts. Examining associated source documents could reveal a vendor consistently benefiting from better deals than others, or suspiciously tied to one of your employees. Similarly, trends help detect practices like ordering excess inventory, shipping goods to unapproved addresses, or even misappropriation disguised as frequent reordering and disposal of scrapped material. Checklist audits further tighten the net. Questions like, is inventory counted by independent employees? Are there safeguards against double counting? Ensure every pebble is turned over. Finally, prevention is the true hero of this story. Think of each prevention measure as a pillar that holds up your company against collapsing under fraudulent schemes. 1. Proper documentation. Everything, requisitions, receiving reports, raw material orders, should be traceable, with controlled numbering to kill chances of duplication or unauthorized entries. 2. Separation of duties. No single individual should have unchecked command over inventory. Divide responsibilities, requisitions, receipts, scrap processing to minimize risk. 3. Independent checks. A fresh pair of eyes outside the usual operations ensures impartial oversight during physical counts. 4. Physical safeguards. Vault-like measures from locked storerooms to strategically placed security cameras ensure access is a privilege, not a free pass. But fraud doesn't only target the tangible. Intangible threats like theft of proprietary information, customer lists, trade secrets, and strategy blueprints can devastate. Often, insiders, not external hackers, are at the core of such schemes. Monitoring and securing data, as well as communicating clear policies on intellectual property ownership, can prevent these hidden heists. In a world brimming with innovation and opportunity, inventory fraud remains a sobering reminder of the risks we face. But with vigilance, sharp tools, and unrelenting commitment to prevention, your company can build a fortress, one that guards its resources and protects its future from the specter of deception. Thank you for watching, and as always, continue learning. Stay curious, and we'll see you next video.